Picture this. You're staring at your trading view screen just before New York Open. ES is hovering around yesterday's high, NQ just wicked both sides of the Asian range, and your favourite Forex pair is coiled under a clean resistance level. You've already done the math in your head. If I size up a bit today, just 2 good trades, and I can make back last week's losses. Maybe even double the account this month. Your cursor floats over the buy button. On the left side of your brain, there's a sensible voice whispering, risk 1R, fix, stop loss, follow the plan. On the right side, dopamine is already cashing in profits that don't exist yet. You imagine the green P&L, the screenshot for Discord, the feeling of finally cracking the market. Your heart rate picks up. Cortisol joins the party. What if this is the move and you're too small? What if you stay at puny size forever? You bump the position size from 1% to 3, then 4. Stop loss? You drag it tighter to improve the risk reward. You click buy, price ticks in your favour, then snaps right through your tight stop, tags you out, and then does exactly what you predicted. Without you. Red P&L hits your screen, your chest tightens. The old Jesse Livermore nightmare plays out again. You got the direction right, but the risk wrong. So you do what 90% of traders do. You smash another entry, this time bigger. No clear stop, no plan, just emotion. That is how most traders fail. Not because they can't read a chart, not because they don't know what a support level is, but because they consistently do the wrong things with risk and profits. And if you don't fix that, nothing else you learn will matter. This is not financial advice. Most traders lose money. Past patterns and examples don't guarantee future results. Your capital is at risk every time you click that button. Risk management isn't a hack to guarantee profits. It's the bare minimum required to survive long enough to even have a chance. So let's talk about what 90% are doing wrong, and how the tiny minority approach risk and profits very differently, including the lessons that made and broke Jesse Livermore, the legendary trader who became a multi-millionaire several times, and blew up several times too. Because hidden inside his story is the blueprint for why most traders fail today. Most traders think their edge is in their setup, the indicator, the pattern, the secret combination of EMAs and RSI and fibs. Jesse Livermore learned the hard way that the real edge is how you handle risk when you're wrong and profits when you're right. The methods that made him fortunes were not complicated. Cut losing positions quickly and without emotion. Add only to winners that are moving in your favour. Sit tight in good positions. Don't jump in and out because of noise. On paper, that looks simple. In real time, with your dopamine and cortisol surging, it's almost impossible without rewiring how you think. Here's the first brutal truth. Most traders size their positions emotionally, not mathematically. They risk more after a loss because they're in revenge mode. They risk more after a win because they feel invincible. They risk the most on the trade that feels obvious because their brain is high on certainty. That's not risk management, that's gambling. Your brain evolved for survival, not for probabilistic decision-making. A red number on your P&L triggers the same primitive circuits as a threat in the jungle. Cortisol spikes, your amygdala screams danger, and your field of view narrows. You stop seeing the chart. You only see the pain, or the fear of more pain. That's why you move your stop loss just this once. That's why you cancel the stop altogether and tell yourself, I'll manage it manually. That's why you add size to a losing position, convinced it can't go much lower. It's the exact opposite of what Livermore did when he was at his best. When he followed his rules, he would never average down a loser. The moment the market proved him wrong, he got out. The loss was small, defined, acceptable. When he broke those rules, he did what most traders do now. He turned small, manageable losses into catastrophic ones. Here's the paradox. The safest trades feel the worst to your emotional brain. The most dangerous decisions feel the best. Risking 1% on a clean setup and accepting you might be stopped out 3 times in a row feels weak, too small, too boring. Going all in to make it back in a single trade feels bold, powerful, finally serious. This is why more analysis doesn't save you. You can add 10 more indicators, 5 more confluence factors, 3 more confirmations. If your position size is insane, you're still 1 candle away from blowing up. Now meet Marcus. Marcus is a modern trader obsessed with Jesse Livermore's story. When he started, he was exactly like most traders. He had a $5,000 account, a TradingView subscription, and a brain completely unprepared for the reality of risk. On Monday, he would risk 0.5% per trade. On Tuesday, after 2 wins, that quietly became 2%. On Wednesday, after a loss, it suddenly jumped to 5 because this setup is A+. He moved his stops, added to losers, cut winners, chased breakouts after the move, and watched the same pattern repeat. Long stretches of grind. One huge impulsive decision, account wrecked. The pattern wasn't on the chart. The pattern was in him. So one night, after another blown week, Marcus shut his laptop, sat in silence, and asked himself a question most traders never face. Honestly, is my goal to be right or to stay in the game? That's where everything changed. He started studying not just Livermore's triumphs, but his collapses. He realized something terrifying. Livermore's technical skill didn't disappear when he lost everything. His ability to read tape, spot accumulation and distribution, ride trends, that was still there. What disappeared was his discipline around risk and profits. He stopped taking small losses. He started trading bigger than his rules allowed. He chased the emotional high of proving himself right to the market. Sound familiar? Marcus also dove into probability thinking. He realized that 1 trade means nothing. 10 trades means almost nothing. What matters is the next 100, the next 300. A single outcome is random. But a large sample, with fixed risk and consistent rules, starts to show your true edge. That led him to the core shift that separates the 10% from the 90%. Most traders treat every trade like a verdict on their identity. The few who succeed treat every trade like 1 data point in a long series. So Marcus rebuilt his trading from the ground up, not with a new indicator, with new rules for risk and profits. Rule 1. Every trade risks the same fixed amount. In R, Marcus picked a number that his nervous system could handle without going crazy. 0.5% of his account per trade. For him, that was 1 R. It didn't matter if it was USD, ES futures, or a tech stock. Every idea got 1 R, sized exactly based on the stop distance. That single decision changed everything. Your brain can handle discomfort. It cannot handle chaos. When you never know if your next loss will be 1% or 30%, your cortisol system lives on high alert, and your decision-making melts. When you know exactly how much you can lose if you're wrong, the emotional spikes start to flatten out. Rule 2. The stop loss is law. No more dragging stops behind price because it's just noise. No more deleting the stop and promising to watch it closely. Before entering, Marcus decided, where is this trade objectively invalidated? Below what wick? Above what high? Beyond what structure? Is this idea wrong? That's where the stop went. And it stayed there. When price tagged it, he didn't negotiate. The trade was done. 1 R lost. Next. This feels brutal to your ego. Every stopped out trade lights up old emotional circuits. Fear of failure, shame, memories of being wrong in front of others. But this is where the paradox kicks in again. The trader who frees themselves to take many small, boring losses is the one who protects themselves from the one loss that wipes them out. Rule 3. Cut losses fast. Let profits breathe, but with structure. Cut losses, let winners run is easy to say and almost impossible to do when your P&L is flashing in your face. So Marcus removed his real-time P&L from the platform. He hid the dollars. All he saw was price, structure, and R. Before entry, he set 2 orders. A stop loss at 1 R risk. A take profit at a reasonable multiple of R, often 2 or 3 R, based on the chart. Then he added 1 more rule. If price moved 1 R in his favour, he scaled partial profits and moved the stop to break even or better, only if the structure supported it. No emotional micromanagement. No closing the trade because the candle looked scary. That's how you start to create positive expectancy. A distribution where your losers are capped at 1 R and your winners regularly hit 2, 3, or more R. Meanwhile, 90% of traders do the opposite. They take full size, unlimited losses because they moved the stop or never had one. They take tiny wins because the idea of giving back open profit feels unbearable. They lose big, win small, and their math is broken before the chart even loads. Under the hood, this is all neuroscience. Every time you take a big, impulsive, oversized trade, and it works, your brain gets a massive dopamine hit. That rewires your expectations. Now normal, sane risk feels dull. Your brain starts craving the high of that all-in payday again. Every time you move a stop, watch the loss grow. And then the market comes back. Your brain learns another dangerous lesson. Pain goes away if I delay it. Cortisol spikes, then falls. You feel relief. The next time, you're even more willing to remove the stop, until the day the market doesn't come back. The paradox is vicious. Your brain rewards you for behavior that will eventually kill your account. It punishes you emotionally for the behavior that would actually keep you safe. This is exactly why Livermore's story is so important. Even at the highest level, with a legendary edge, the brain's wiring can drag you back into the same destructive loop if you don't have rules stronger than your impulses. Marcus understood that he couldn't feel his way into discipline. He had to design it. So he treated his trading like a lab. He journaled every trade, the setup, the risk in R, the outcome, and, crucially, his emotional state. Heart racing before entry. Felt FOMO seeing Discord callouts. Was tempted to move stop when candle wicked. Over time, patterns emerged. He discovered that his worst decisions came after he scrolled social media, after a big win, or after a big loss. That's when his dopamine or cortisol was highest. So he built circuit breakers. No Twitter or Discord during trading hours. If he hit his daily loss limit of 3R, he stopped trading. No exceptions. If he had a monster green day, he cut his size in half the next day to reduce overconfidence. Instead of trusting his feelings, he protected himself from them. This is where we come back to you. If you're honest, which side of this line have you lived on so far? 90% of traders risk a random amount based on how right the trade feels. Move or delete their stop loss when price goes against them. Add to losers because it can't go lower, and they want to fix the loss faster. Cut winners quickly because they don't want this to turn red. Take more trades after a loss to make the money back. Take more trades after a win because they feel unbeatable. 10% of traders risk a fixed R amount on every trade, no matter how good it looks. Decide the stop and target before entry, not after pain starts. Never add to losers. They sometimes add to winners in the direction of the move. Accept many small, boring losses to avoid catastrophic ones. Treat each trade as one event in a long series, not a verdict on their worth. Jesse Livermore's real legacy isn't just trend following or tape reading. It's the lesson that technical skill without psychological discipline around risk and profits is a loaded gun pointing at your own account. So what do you actually do with this? Start simple. First, define your R. Pick a number that you can genuinely lose 10 times in a row without losing your mind. Maybe that's 0.5% per trade. Maybe it's a quarter. For a while, smaller is better. You're not trying to get rich this month. You're trying to become someone who can survive this business for years. Second, commit. Really commit to using a hard stop loss for every trade. No, I'll decide after entry. If you don't know where the trade is invalidated, you have no business clicking the button. Third, hide your dollar P&L during the session. Force yourself to think in R, in structure, in probability, not in, oh my god, that's $200. Fourth, track your behavior, not just your results. If you followed your risk rules and still lost money, that's a good trading day. You did your job. If you broke your rules and made money, that's a bad trading day. You just fed the addiction. And finally, accept the most uncomfortable truth in this whole game. Your job is not to make as much as possible, as fast as possible. Your job is to avoid doing what destroys almost everyone. If you can simply not do what blows up 90% of traders, oversized risk, no stop, adding to losers, cutting winners, you have already separated yourself from the herd. From there, refining your entries, sharpening your setups, improving your read of trend and context. That actually starts to matter. Picture Marcus a year after that breakdown moment. Same desk, same charts, same markets. But his equity curve looks very different. Jean-Fa, it's not a straight lineup, it never is. But the massive plunges are gone. His drawdowns are smaller, controlled. His winners are bigger than his losers. His position size has quietly grown because he has earned the right to scale, not because he was bored or angry. He still feels fear before big trades. He still feels temptation to move his stop. He's still human. But his rules protect him from the worst version of himself. You can build that too, because in the end, the market doesn't care about your opinion, your hopes, or your dreams. It doesn't care if you're 20 years old or 60, trading from a laptop or a full trading floor. The only thing that matters over thousands of trades is how you handle risk when you're wrong and profits when you're right. Jesse Livermore proved that you can be a genius on the upside and still end at zero if you don't respect that. The question is, are you going to repeat his worst mistakes and the mistakes of 90% of traders today? Or use his story as the line you refuse to cross? You don't control the next candle, but you absolutely control how much of your account it can take with it.